The markets are heading straight to all-time highs. We broke out of this trading range that we were stuck in for around a month. We broke out and we are heading straight to all-time highs as we expected when we broke out. The markets have been in a pattern of leg up, consolidation, leg up, consolidation, leg up for the past few months since the March low. And that is completely normal. It is to be expected. The markets do not go up in a straight line. You get ups, you get downs. As a rally starts to get overbought and overextended, you will get corrections to work off those overbought conditions. Now we're going to cover why we believe that there is a short-term correction coming in the markets, probably similar in size to this island top reversal pattern. And it's likely going to give us a great buying opportunity when it starts to bottom out, just like it did here. Back here on the 15th of June, we made a community post highlighting those divergences with a nice trend line, a wedge pattern, the MACD slowing down in momentum, and we nailed the bottom of that correction. So we do believe that the markets will bounce after this correction and that we will be heading higher. You can check out our last video discussing why we believe that's going to be the case. But as we speak, the markets are starting to get overextended. We do think that there is room for a last leg up before we have that big trap at the all-time highs and have a nice false breakdown for a big correction. Before we look at all of this, we're going to take a look at how healthy this rally actually has been. We're going to clear this chart. It is very important to know how healthy an actual rally is. You're going to see a lot of articles talking about the fact that the tech stocks are the ones that are pushing this entire rally up to all-time highs, that the NASDAQ 100 is the only thing that's going up and everything else is going down. But if we take a look at this rally that started here 1st of July, we'll say the entire month of July was this rally, and we take a look at the NASDAQ throughout this time, NDX, the NASDAQ 100 index, you're going to see that the NASDAQ actually peaked beginning of July and actually traded sideways up until very recently. So the NASDAQ has actually been underperforming the markets for this entire month of July. If we take a look at other sectors like XLI, that includes industrial stocks, it's the industrial sector of the S&P 500. You're going to see that the rally started here and XLI has actually been outperforming. And that's not something that you're going to see on your typical financial media, CNBC. You're not going to see articles discussing why industrials are pushing this last leg up in the markets. But we actually saw tons of articles talking about the fact that they were underperforming the markets throughout this period right here. So if you enjoy this type of more in-depth analysis of the markets, actually taking a look at what's pushing the markets higher, make sure to like the video to give us some support for us to continue making these types of videos for you guys. Now we can take a look at another sector, XLF. These are the financials. It's the banking sector of the S&P 500. And again, you can see from the 1st of July, around right here, the financials have been pushing the markets higher. Now, of course, they haven't taken out this high because they were underperforming right here before earnings, but then we got earnings and they've actually been pushing the markets higher on this last leg up. So tech is not pushing this last rally. This last rally on the S&P 500 is about as healthy as it can be. And we do think that there is still some upside potential left with the NASDAQ that's currently back on an uptrend, breaking out to, again, new highs. It might take us for another leg up, possibly to the 3,450, 3,500 points. The put call ratio is just going to get absolutely extreme. So we can take a look at the put call ratio. This is a graph showing the put call ratio for the S&P 500. And so I like to think of this as the short-term sentiment indicator. And you can see right here, this was the March low right there, and we had an extreme reading with an incredibly high amount of puts in the markets versus a very low amount of calls. You can see that extreme put call ratio reading corresponds exactly to the bottom of the March stock market crash right here. And so this is something we've taken a look at many times on this channel. If you can time these readings, these extreme readings in the markets, you're going to be pretty successful at timing tops and bottoms in the markets. This was another major high. This was the island top reversal we had about a month ago, where we had an incredible amount of calls in the markets. Everyone was betting that the markets are going to go higher. And if we look on the S&P 500, you can see this was the island top reversal that corresponds to that extreme reading on the put call ratio. So you can start to see how these extreme readings in the put call ratio can correspond to major shifts in a trend. And pretty much all of these extreme readings played out for very nice trades. And we are currently sitting at a very extreme reading, not just yet at the level we were at here, but we are starting to get a little bit closer. If we do have one more leg up in the markets, it's going to look something like this, and that's going to provide a very nice shorting opportunity. When you have the put call ratio at such low readings or such high readings, you are going to want to have a little bit more caution in the markets. And we put out a community post yesterday talking about this. It is time to have some caution in the markets if you are long. And the most important thing about this chart is that you should drop a like on this video to show some support for the Game of Trades channel. So thank you very much for doing that. So we're going to have a very nice combination of factors. We're going to have an extreme put call ratio reading as we get to the all-time highs, as we get that last leg up. We're going to have all those headlines in the news talking about all-time highs, sucking in more retail money into the S&P 500. And at the same time, we're going to be breaking out with the MACD waning down just like this. So this is a momentum indicator. The MACD is a momentum indicator, and this type of divergence with the MACD waning down and the price actually making a higher high tells you that this is not a very powerful move. And so if you're going to break out on a weak momentum move, that is 9 times out of 10 going to be a false breakout. And that's going to give us a very nice wedge pattern to trade. We're going to have divergences like this as the price gets to the all-time highs, and a nice trend line to work off from this low here, capturing this one here, and this reaction right there. This is probably the most plausible trend line to look at for now. So this is going to be a very nice trade to make, a very high probability trade with a nice sell signal to wait on the break of this trend line. But until we do break that trend line, we do expect more upside. And this is something that we talked about right here as we were breaking out of this island top reversal. We had divergence right there, and I remember seeing a lot of people talking about the fact that we had divergence right there, and we made a video covering this divergence and talked about the fact that we could very well see those divergences extend to all-time highs before the wedge pattern actually breaks down and plays out for a nice correction. So we're going to also take a look at what kind of targets we're looking at for this correction. The first target is going to be this 3,260 point level. We do think that we are going to revisit that level. And the next 2 targets are potential targets. We do not have to hit those targets, but considering the scope of the divergences, it's absolutely possible that we do hit both of these next 2 targets. And that would mean that if we make another leg up into all-time highs and then reverse, that would be a nice almost 10% correction to the final target. So of course, from the break of trend line, that would be around 6-7%. Now, of course, if you are not a short trader, you can use this kind of setup for buying opportunities, which is definitely something that we're going to be doing. You can also use this short trade as a way to hedge longs. If you still have longs from here and you don't want to exit your position, you can start a short trade on a break of that trend line to hedge your long. And now the big question is, could this morph into something bigger, into an actual drop much lower and potentially continue the bear market? For now, we do not think so. Again, we have a healthy rally, a lot of liquidity, a lot of bearish sentiment in the market that's going to be pushing the markets higher. So we do not think that this is likely going to break down. But of course, this 3,000 point level right here is the level to watch. If we start breaking down below this level right here, that would start becoming very worrying. And a short trade breaking below this level is absolutely objective, down back to the 2,800 point level. If we start to see the markets go down over 10%, that would be worrying for the bullish case. But until we manage to break down below those moving averages, the 50-day moving average, the 200-day moving average, there is nothing to worry about for the bullish case. So that's about all I wanted to cover in this video. If you're interested in checking out our charting platform, you can click the link in the description below. Again, make sure to like the video if you enjoyed and subscribe to the channel if you want more content like this. In the meantime, good luck on your trading and see you next time.